How are you, folks? Enzo DiCostanzo, clinical professor, economics and finance in St. Peter's in Jersey City. And today we're going to be continuing our discussion on audit. We're going to talk about internal control, corporate governance, and going concern. All very good economic topics. Yeah, so we left off here yesterday with internal controls. They're the mechanism, rules, and procedures implemented by a company to ensure the integrity of financial and accounting information, to promote accountability, and to prevent fraud. And I think, whoops, this is the cover page. That's not what I wanted. There it is. Yeah, so in terms of the questions, I mean, we're going to go over the questions again, but we stopped at pretty much 6. And then 7 is, what does an auditor's opinion of company? We're going to go over that. We're going to go over the report. That might be another video where we actually go over these questions. I just want to get through the lecture of these, and this is about 8 or 9 pages, so that's a bunch of pages. To ensure the integrity of financial and accounting information, to promote accountability, and to prevent fraud. Okay. So it's fraud prevention is a big piece of that. You're promoting accountability. And actually, I left out the verbs, so we'll just do it like that. Okay. But that's what internal controls are. Mechanisms, rules, and procedures. And again, think about with 500,000 people working for you, and God knows how many people are in and out of the front doors of Home Depots, across America and across the world, to control all of that, to make sure that there's not I think I said it yesterday, that there's no parallel company being run out of the Belleville Home Depot. I don't think there was one, or the Secaucus Home Depot, or the Home Depot up in North Bergen or something. There's the people working there are taking half the inventory and selling it themselves, and not kicking the money back down to Georgia. So you want to avoid all that. And it sounds, that can never happen. Trust me, the inventiveness of people will never disappoint us. So besides complying with laws and regulations and preventing employees from stealing assets or committing fraud, internal controls can help improve operational efficiency by improving accuracy and timeliness of financial reporting. I'm always a big believer in not undermining the system, but that's the world that we live in now, I think, is all about undermining the system, unfortunately. But I'm all about supporting the infrastructure as to what's going on. And these are just some sort of brief descriptions of what we're going to talk about here. We're going to repeat mechanisms, rules, and procedures implemented by a company to ensure the integrity of financial and accounting information, to promote accountability and prevent fraud. We said that already. Besides complying with laws and regulations and preventing employees from stealing assets or committing fraud, internal controls can help improve operational efficiency by improving the accuracy and timeliness of financial reporting. Financial reporting is the key word here. And also, the internal audit plays a critical role in the company's internal controls and corporate governance. Now that Sarbanes-Oxley, which again, I've avoided diving in class talking about the tax code changes in 2017 and the Sarbanes-Oxley, because once you start going down that path, that's going to absorb a lot of time. That's why I've avoided talking about that. You should take that in law school or something, or legal studies program or something, where they talk about the SEC. Like, and I didn't talk about the Securities and Exchange Commission legislation and the case law that goes with it, because then you have to start talking about the case law and everything that sort of goes with it. And it's like an iceberg where the tip is pointing out of the water. There's a hell of a lot below it that you have to sort of look at. So, Sarbanes-Oxley made managers legally responsible for the accuracy of the financial statements, and that the guys down in Atlanta for Home Depot are not going to take the hit if there's a problem. They're going to say, hey, it was the Belleville store, it was whatever, the store out in Wyoming somewhere, whatever it was. So these are key business function for every U.S. company, since the accounting scandals about your lifetime ago, which I'm sure you don't remember, in the wake of Sarbanes-Oxley in 2002 was enacted to this is not 2020. This is 2002. This is about 20 years ago, which is about the age of most of the people watching this right now. So it was enacted to protect investors from fraudulent accounting activities and improve the accuracy and reliability of corporate disclosures. See, what happens is in your head, you create that you're so powerful, so important, so wealthy, so capable, that you understand what's going on so well that no one can touch you. And if you watch documentaries about people who've been caught in, these very big racketeering, criminal enterprises, the guys in Miami who were caught, shipped from Medellin into the Miami area and then into the rest of the country, shipping illegal drugs from Colombia. Not picking on Colombia, but just that was the documentary in my head that came out about 15 years ago or so when I was just getting out of Fordham. There was a documentary about Miami. What was the guy's name? I forget the guy's name. Roncontour, not Billy West, but anyway, Billy Corbin. Good documentary Limelight. He did a couple other good documentaries that at least for me, capture my sort of time as in America growing up. But I remember watching the documentary about the Miami guys and the guy John Roberts, who was an Italian guy or an Italian connected guy from New York who went down to Miami. Really tremendous story. And he said it. He says, we were untouchable. They had airports, planes, hangars. This was a Home Depot for illegal drugs. It was just it was a sophisticated operation, and the money and the narcotics that came into America through this operation was gigantic. And in their minds, they said, well, no one's ever going to touch us. All it took was one person with a weakness getting caught with some low-level thing that he wanted to get out of, and that's how all the dominoes fell. But they were, in their minds, they were going for years and years and years, undetected, according to them. Now, who knows how true that really was? But so again, when you have so many people involved, it's not the Marines. There's going to be weakness. There's going to be problems. There's going to be people who are going to turn. There's going to be people who try to make a deal. There's going to be people who are going to, always try to manipulate that situation to their advantage. And then the whole house. And I'm not defending. Certainly, I'm not defending any of it. But and Sarbanes-Oxley was developed to at the corporate level. So let me tell you, the problems were Tyco were just as bad as some of these racketeering organizations. It was just as bad. It's just very excessive, and all the vices of mankind. You could list all the vices that you want to list, and it's the idea is it's supposed to control, but human nature's got goes up more, right? Always. So it's we'd like to think it's going to control. We hope it's going to control. I'll say it like that. Auditor's opinion that the company's financial statements is based on an audit of the procedures and records used to produce them. So again, procedures and records. Okay, those are sort of now. Just to sort of preface this, there aren't any specific questions on internal control and corporate governance and going concern. But in accounting, these are very important topics. I just want to take the hour or whatever it is and just sort of go over this stuff with you guys. As a part of the audit, external auditors will test the company's accounting procedures and internal controls and provide an opinion. So you can see we're talking the same language. We're talking the same language with all of this. It's their effectiveness. This is for external auditors. Okay, this is for so you can see we're almost repeating what we were talking about. That is being asked. It's just another version of what's being asked. Internal audits evaluate a company's internal controls, including corporate governance and accounting processes. Okay, they ensure compliance with laws and regulations and accurate and timely financial reporting and data collection, as well as helping to maintain operational efficiency by identifying problems and correcting lapses before they're discovered. In an external audit, internal audits play a critical role in a company's operations and corporate governance. And now that Sarbanes-Oxley has made managers legally responsible for the accuracy of the financial statements. No two systems of internal controls are identical, but the core philosophies regarding financial integrity and accounting practices have been standard management practices. While internal controls can be expensive, properly implemented internal controls can help streamline operations and increase operational efficiency, in addition to preventing fraud. Policies and procedures established by an organization only reasonably assurance may be provided by that the internal controls are effective and financial information is correct. The effectiveness of control is limited by human judgment. Businesses will give high-level personnel the ability to override internal controls for operational efficiency reasons, and internal controls can be circumvented through collusion. So, and I've seen that. I've really seen, especially in the legal system, especially the local legal systems. I've seen things like that. It's not pretty, and it shakes your faith in, how the country is running itself. Stand the call. So Congress passed Sarbanes-Oxley about 20 years ago to protect investors from the possibility of fraudulent accounting activities by corporations, which mandated strict reforms to improve financial disclosures from corporations and prevent accounting fraud. So preventative versus detective controls. They're comprised of control activities, authorization, documentation, reconciliation, security, separation of duties, and they're broadly divided and preventative into preventative and detective activities. I don't know if I'm going to be able to quickly find this, but I know something happened a number of years ago. Oh, who was it? Drew? Was it Drew? I think it may have been Drew. And there was like the finance person who'd been there forever. It was like 20 years ago, so it might be hard to find. Yeah. You're not going to easily find something, especially something that happened such a long time ago. But there was somebody in the financial area of the school, and yeah. Yeah, this thing was with the federal aid, but that's not what I'm talking about. This was a long time ago. All right, well, but there was something where you had one person confirming amounts to be paid to contractors, another person and the same person was recording them, the amounts to be paid to contractors or to pay the university bills, and it was all the same person. One person writing the checks, another person keeping the records, and that was all the same person, and that's what the problem was. But anyway, so yeah, preventative controls. No single individuals to authorize, record, and be in custody of financial transactions and the resulting assets. So yeah, that's for preventative. For detective, their backup procedures designed to catch items or events that have been missed by the first line of defense. Here's the most important activity: is reconciliation, to compare data sets and corrective actions taken upon material differences. Other detective controls include external audits from from accounting firms and internal audits of assets such as inventories. So certainly. Techniques and control methods from England migrated to the United States in the Industrial Revolution, and the 20th century orders, reporting practices, and testing methods were standardized. I forget the guy, the policing guy who started the idea of law enforcement. Let's see. Who started law enforcement in England? Who was that? The history of law enforcement. The guy had a name. In the UK, and it came over, not Kirkwood. Peel, Robert Peel. I think that was the guy. Yeah, and he had like the 10 Peel, the 10 Peel concepts of law enforcement or something to that effect. Legacy, career. It wasn't Gash. It wasn't Lawrence. I think it was Peel. Anyhow, so but yeah, these ideas are not new ideas. Then it says, why are internal controls important? What are the two types of internal controls? You have preventative and detective controls. And actually, those could be highlighted. All right. Some of the why are some why are some of the preventive or what are some of the preventive internal controls? Separation of duties, okay, authorization of invoices. So no single individual to authorize, record, and be in custody. Authorization of invoice verification expenses, limiting physical access to equipment, inventory, cash, and other assets are examples of preventative internal control. So all the record keeping, sort of following the paper trail, is extraordinarily important. So those are preventative, detective internal controls, similar processes, or to detect problems or processes once they've occurred. And these are in accordance with quality control, fraud prevention, legal compliance, right? Reconciliation, comparing data sets, corrective actions taken if there's material differences, other detective controls, including external audits from accounting firms, internal audits of assets such as inventory. So now you're getting shades of meaning as to what's detective, what's preventative. It's all supposed to be preventative. That's the idea. The entire thing is supposed to be preventative. And again, what are internal controls? Are mechanisms, rules, and procedures implemented by a company to ensure integrity of financial and accounting information and promote accountability. Okay, and prevent fraud. Okay, so there's a lot of pieces to this. And Sarbanes-Oxley is legislation in the wake of the accounting problems 20 years ago to protect investors from fraudulent accounting activities and improve the accuracy and reliability of corporate disclosures. So basically, without getting very much into Enron, I met people who worked for Enron when I was at a conference at Princeton about 20 years ago. That debt was, sort of bad news was hidden in something called off or special purpose vehicles or off balance sheet vehicles, and it was significant that if that information was on the public balance sheet, they see there was a private balance sheet and a public balance sheet. That if it was on the public balance sheet, it would have made a very big difference in how the banks interacted with the company and what the valuation of the company was or were. Okay, so that's not minor. Second topic, what a going concern is an accounting term for companies that has resources needed to continue operating indefinitely until it provides evidence of the contrary. Okay, so it means, in other words, it's an accounting term for a company that has the resources needed to stay in business. The ability to make enough money to stay afloat or to avoid bankruptcy. If a business is not a going concern, it's gone bankrupt and the assets were liquidated. .coms are no longer going concern companies after the tech bust. Okay, so again, so a going concern means it can keep operating. That's basically what a going concern is. Financially stable, meet its obligations, continue business for the foreseeable future. Expenses and assets may be deferred in financial reports. Okay, if a company is assumed to be a going concern, if it's no longer a going concern, it's got to start reporting certain information, right, in the financial statements. And negative trends that lead to no longer being a going concern includes denial of credit, continued losses, and lawsuits. So again, if you're not alone, if you're no longer in business, you got to say, hey, what's our final notice time, or what's our final state of the company. The going concern principle is just decide what types of reporting should appear on financial statements. The going concern principle. Financial statement. Companies are going concerns may defer reporting long-term assets at current values or liquidating values, but rather a cost. Yeah. So again, that's mark-to-market accounting, current value or liquidating value. That means what you can get for your assets today versus cost, which might be a lot higher, and give you better credit terms with banks because you have, at least on paper, there's more assets, and then you can be extended, larger amounts of credit, which is what the Enron problem was. So company remains going concern when the sale of assets does not impair its ability to continue operations, the closure of a small branch that reassigns employees to other departments within the company. Accountants who view a company as a going concern generally believe the firm uses its assets wisely and does not have to liquidate anything. So we have some acquisitions sort of in our crosshairs overseas that just seem to always need government money to keep operating, and that's you can't run a business like that. We also apply going concern principles to determine how a company should proceed with the sale of assets, reduction of expenses, or shifts to other products. It's not included in GAAP, but it is included in the generally accepted auditing standards. Now, again, we really don't talk about what generally accepted accounting principles, but just very basically how to recognize revenue, how to recognize expenses, and a bunch of other things. Okay, it's not just those two concepts. So that's the beginnings of generally accepted accounting principles. How you recognize a revenue, how you recognize an expense, how you document that, and many other things. Red flags that indicate a business is not a going concern can appear on financial statements of publicly traded companies. that indicate a business won't be a going concern in the future. Listing of long-term assets normally does not appear in a company's quarterly statement or as a line item on balance sheets. Yeah, so again, for the folks who may or had a little analyst experience, or maybe will be going into asset, securities analysis or things of that nature, when the quarterly reports for Apple come out or Microsoft, they don't have balance sheets. It's just the corporate performance. Okay, because it's considered a going concern, and we haven't gotten all the records together yet, and those numbers might be changing during the year, and we can't tie up some of the loose ends of some of the transactions in 3 months or 6 months or whatever it might be. So just there's a whole list of excuses to not do it. I think it's just to keep people in the dark a little bit more and to give the company the advantage of operating. But that's my humble opinion. The listing of value of long-term assets may indicate a company plans to sell the assets. A firm's inability to meet its obligations without substantial restructuring or selling of assets may also include, also indicated as not a going concern. If a company acquires assets during the time of restructuring and may plan to resell them later. And here's some conditions for what a going concern is. Accounting standards try to determine what a company should disclose on its financial statements. If there's doubts about its ability to continue as a going concern, FASB, which we have a colleague from St. Peter's who's up there in Connecticut, determined financial statements should reveal the conditions that support the entire substantial an entity's substantial debt. The FASB determined financial statements should reveal the conditions that support an entity's substantial doubt that it can continue as a going concern. Statement should also show management's interpretation of the conditions and management's future plans. Okay. Right. If there is some doubt, it's got to show why there's doubt that it's going to be a going concern. And the auditor examines the company's financial statements, see if it can continue for 1 year following the time of the audit. Conditions that lead to substantial doubt about a going concern include negative trends in operating results, continued losses from one period to the next, loan defaults, lawsuits against the company, and denial of credit by suppliers. Okay, and the last piece of this, and this is something that I've got to be dealing with, which is why I decided to talk about it, is corporate governance. So we may be acquiring an entity out in Europe, and we have to name a board and structure all this stuff. So I just wanted to have a little bit of a discussion with you guys about this. It's a system of rules, practices, and processes by which a firm is directed and controlled. Rules, practices by which a firm is directed and controlled. Corporate governance essentially involves balancing the interests of companies, many stakeholders such as shareholders, senior management, executives, customer, suppliers, financiers, the government, and the community. Stakeholders, stakeholders and shareholders are not the same thing. Stakeholders is a general term. A shareholder is a subset of stakeholders. Stakeholders includes all of these: customers, suppliers, executives. Corporate governance also provides a framework for attaining companies' objectives. It encompasses practically every sphere of management, from action plans, internal controls, performance measure, corporate disclosure. So again, it's a structure of rules, practice, and process used to direct and manage a company. A company's board of directors is a primary force in influencing corporate governance. Bad corporate governance can cast outcomes, operations, and ultimate profitability. Corporate governance entails areas of environmental awareness, ethical behavior, corporate strategy, compensation, risk management. There's committees outside of the board of directors. There's usually several: compensation committee, risk committee, credit committee, those kinds of things. Basic principles of corporate governance and accountability are accountability, transparency, fairness, and responsibility. Sure. Governance refers specifically to, again, set of rules, controls, policies, and resolutions put in place to dictate corporate behavior. So it's rules, controls, policies, resolutions. The proxy advisors and shareholders are important stakeholders who indirectly affect governance, but these are not examples of governance itself. The board of directors is pivotal in governance and can have major ramifications for the valuation of the company, the decisions that board makes, and allows the people operating the company what that board allows them to do. The corporate governance is important to investors since it shows the company's direction and business integrity. Good corporate governance helps companies build trust with investors in the community. As a result, corporate governance helps promote financial viability by creating long-term investment opportunity for market participants. Communicating with firm's corporate governance is a key component of community and its investor relations. On Apple Inc.'s investor relations site, for example, the firm outlines corporate leadership. Now, a firm like Apple is a very large, influential, public American company. What our acquisition is a company never heard of in a country you never heard of. So, it's different. It's very different. And then some people, the thing about Europe is they're very bureaucracy addicted, where they think, well, we have a bureaucracy set up, everything else should be fine. And if you don't have the creative idea, that's I would say the big difference between America and Europe is America. We've got people say, hey, here's 1, 2, 3, 4. Here's what we should pursue. Let's make the infrastructure. But just making the bureaucratic infrastructure, it's not enough. It's not enough. So, for example, the firm outlines its corporate leadership, its executive team, its board of directors, and corporate governance, including committee, charters, government documents, bylaws, stock ownership guidelines, articles of incorporation. Shareholders, I'm saying for many shareholders, it's not enough for a company to really be profitable. It needs to demonstrate good citizenship through environmental awareness, ethical behavior, sound corporate governance. Well, good corporate governance creates transparent set of rules and control. The shareholders, directors, and officers have aligned incentives, and that's a big piece of it that everyone's pointing in the same direction. The private equity firm that I worked for about a decade ago was not that way. The guy who ran it was running it for himself, and what he could get out of people, he would get out of them, and he really didn't care if people profited or didn't profit, or as long as he was doing well, that's all he cared about. And and that company had way longer of a life than it should have had. Now it's reshuffled a bit with the person who's sort of the main problem is not here anymore. The board of directors is the primary direct stakeholders influencing corporate governance. Directors are elected by shareholders, appointed by other board members, and they represent shareholders of the company. The board is tasked with making important decisions, corporate officer appointments, executive compensation, dividend policy. Board obligations stretch beyond financial optimization as to where shareholder resolutions call for certain social and environmental concerns. Yeah, we keep seeing the whole environmental thing. We know that. We know that's got to be sound. We keep repeating that. Board of directors should consist of a diverse group of individuals. Those have skills and knowledge of the business, as well as those who can bring fresh perspective from the outside of the company and the industry. Okay. Yeah, inside and independent members. Insiders can be major shareholders, founders, executives. Independent directors don't share the ties of the insiders, but are chosen because they're experienced managing or directing other large companies. Independents are considered helpful for governance because they dilute the concentration of power and help align shareholders' interests with those with the insiders. So, board of directors must ensure the company's corporate governance policies incorporate this is a strategy committee, risk committee, ethical business practices, whatever. You could have committees on all this stuff. There's a couple examples here, and I've discussed some of these already. There's some questions here, what the bottom line is. Okay, so some of the examples are what? What are some of the examples? Volkswagen. I'm not really familiar with this one, but it's bad corporate governance can cast doubt on a company's reliability, integrity, and obligation to the shareholders, all of which have implications on the firm's financial health. Tolerance or support of illegal activities can create scandals like that rocked Volkswagen starting in September 2015. Dieselgate, the affair came to be known as, revealed that for years the automaker had deliberately and systematically rigged engine emission equipment and cars to manipulate pollution test results in America and Europe. Volkswagen saw its stock shed nearly half its value in the days following the start of the scandal, and its global sales for the first month following the news fell 4.5%. The board structure was a reason for how the emissions rigging took place and was not caught earlier. In contrast to a one-tier board system that is common in most companies, Volkswagen had a two-tier board system, which consists of the management board and the supervisory board. The supervisory board was meant to monitor the management board and approve corporate decisions. However, it lacked the independence and authority to be able to carry out those roles. But yeah, that's the fundamental problem with anything really going wrong like this, is that there's conflicts of interest, and this is my friend, and we're getting paid, and we're making money together. Now I got to point out that you did something you shouldn't have done, and it's right. We've heard this story over and over and over again. So the supervisory board comprised a large portion of shareholders. 90% of the shareholder voting rights were controlled by members of the supervisory board. There were no real independent supervisors. Shareholders were in control of the supervisory board, which canceled out the purpose of the supervisory board in the first place, which was overseeing management and employees and how they operate within the company, which of course included rigging emissions. So that's quite an undertaking to get something like that done. I mentioned Enron and WorldCom in a little about 15, 20 minutes ago. This was a big malfeasance, which means you're not doing what you're supposed to be doing in your job situation. There's a documentary, there's a book about it. I think one of the classes, somebody was reading that book a couple years ago. Students were asking me, say, hey, what do you know about Enron? It was like 4 or 5 years ago. Some of the professors somewhere were maybe teaching that book. Highly publicized revelations of corporate malfeasance revived interest in the subject. Corporate governance became a pressing issue in the United States at the turn of the 21st century after fraudulent practices bankrupted high-profile companies such as Enron and WorldCom. Enron was the board of directors waived many rules related to conflicts of interest by allowing chief financial officer to create independent private partnerships and do business with the firm itself. What actually happened was that these private partnerships used to hide debts and liabilities, which would have reduced the company's profits significantly. What happened at Enron was a lack of corporate governance. It should have been prevented in the creation of these entities that hid the losses. The company had also a corporate atmosphere that dishonest people down to traders made illegal moves in the markets. Yeah. So again, if you're led by somebody who's skirting the rules, the lowest guys can say, hey, I'm going bananas trying to do everything how I'm supposed to be doing, and the guy in the C-level suite is just doing whatever. And there was a whole. And there's nothing wrong with dirt bikes and corporate outings, but the idea was someone I remember an interview that sticks in my head all these decades later. Someone was interviewed about the corporate outings. Instead of like a picnic or whatever, they were riding dirt bikes in California and the Nevada desert, and people were breaking arms and legs, and they kept going. And that whole, not that the Marines are bad, but that whole, you keep going for as long as possible sort of attitude. And being very reckless and being a tremendous risk taker personified itself in sort of the activities that people were involved in. Again, nothing wrong with skydiving or deep sea diving or any of those kinds of things, but you want to know what people's habits are, because it's gonna give a lens to what's really going on with the people that you work with. So WorldCom was similar, but they were just hiding expenses or recognizing revenues or whatever it was, and they were just not following GAAP is the bottom line. So Sarbanes-Oxley imposed stringent record-keeping requirements on companies and stiff criminal penalties for violating them and other securities laws. The aim was to restore public confidence in public companies and how they operate. Because if you have pension funds buying these shares, and all of a sudden that just the bottom drops out of those pension funds, people who are firemen for 20, 30 years, or teachers or law enforcement or whatever it might have been, and you're leaving them in a lurch. And if you've been in a job like that, it's hard in your 50s to just, let me just transition to something else. If you're an accountant and you move from one firm to another, in your mid 50s, that's one thing. But generally, that skill is, the civil service, public service. What's a fireman going to do? Become a welder or something? Or they're not going to all of a sudden go start nothing against fire people, but they generally haven't developed the skill set to go start a computer company in California somewhere. They're not going to really be able to do it in their 50s. So it's more important than ever, the people who've dedicated their 20s, their 30s, it's almost like the marriage thinking about why people who are married and they get divorced, the one spouse gets half the resources of the other half of the marriage, because you've dedicated your life working a certain way and not really thinking that, hey, I've got to be prepared later for another 5 decades of life to work probably another 20 years at something that's not going to be so physical any longer, because the job you're doing at 25 is not the same thing you can do at 55. And do you have the toolbox of skills to go into business or to go into something else? Or not everyone can go into private security or open a bar, or those sort of the traditional second career of law enforcement guys or firemen or things that's not going to be everyone's cup of tea. And so how prepared are you? So the pension's got to work. That's why it's very important where we have these as much assurance as possible that what these pension funds are investing in is going to be sound, and value's not going to go to zero when people need their pension payments. The PepsiCo, I wasn't familiar with this. What the scandal was here? PepsiCo. What happened with PepsiCo? PepsiCo, good corporate governance. Okay. Took input from investors. Fine. And okay, yeah. There's nothing. Yeah. This is just an example of a good company. So yeah, the Enron and WorldCom were bad examples. Volkswagen was a bad example. PepsiCo was how to do this the appropriate way. diversity, leadership structure, turnover, long-term strategy, corporate purpose, sustainability issues, good governance practices, human capital management, compensation discussion analysis, shareholder and stakeholder engagement. So the company did all of this and said, okay, one company that's consistently practiced good corporate governance and seeks to update it often is PepsiCo, drafting its proxy statement, took input from investors to focus on these 6 areas. And here's the 6 areas. Include a proxy statement with a side-by-side graphic that depicted the current leadership structure, which showed a combined chair and CEO along with independent presiding director, and a link between company's compensation and companies winning with purpose vision, and changes the executive compensation program. Okay. So as an investor, you want to ensure the company you're looking at buying shares practices good corporate governance in the hope of avoiding losses in cases such as Enron and WorldCom, where certain areas that an investor can focus on to determine whether a company has good corporate governance or not. And again, those companies, whatever investment was in those companies, bottomed out to zero. What was the good movie? It was in the Dick and Jane or Fun with Dick. It was Jim Carrey was in it, and they were 2 California, corporate types, and that they both had jobs, and Jim Carrey he was a communications director for a technology company, and they had fictitious Globodyne and technical company this and whatever, but it was supposed to it was really modeled after what happened with Enron, and it showed the lengths that the people who maybe they're in some sort of bureaucratic job in a corporation, and then that just falls through. And he was working as a laborer. They were working at a fictitious Walmart, and they had to do drug testing and all these sort of unusual things. And they were in the executive suite having eggs made for them in the morning, kind of a situation. And it shows the CEO of the company getting in a helicopter and just helicoptering off. And he goes, "My daddy said," always used to say, and never finished the sentence. And the CFO was at a local, like a businessman's club in the downtown area, and he was shooting and drinking, and they were doing banking, shady banking transfers, and the whole. You have to watch it. It's called Fun with Dick and Jane, but it's about the culture of what happened with Enron. So anyway, it says easier to disclose. These areas include disclosure practices, executive compensation. It's tied to performance or other metrics, risk management, policies and procedures on reconciling conflicts of interest, business decisions that might conflict with mission statements, members of the board of directors, do they have a stake in that? So here's some of the questions. So executive compensation, is it tied to performance or other metrics? Risk management, what are the checks and balances for making decisions in the company? Policies and procedures on reconciling conflicts of interest. How does the company approach business decisions that might conflict with its mission statement? Members of the board of directors, do they have a stake in profits? Contractual and social obligations. How do they approach areas such as climate change? Oh boy. Relationships with vendors, complaints received from shareholders and how they were addressed, and audits. How often are internal external audits conducted, and how have they been handled? Okay, so types of bad governance practices. Poorly structured boards make it too difficult for shareholders to oust ineffective incumbents. Bad executive compensation packages that fail to create an optimal incentive for corporate officers. Don't cooperate sufficiently with orders, or do not select orders with appropriate scale, resulting in the publication of spurious, a line of reasoning, apparently not actually valid, or non-compliant financial documents. Spurious, apparently, but not actually. Yeah, so just sort of phony baloney audit reports, basically, is what that means. And there's a couple questions here. What are the 4 P's of corporate governance? People, process, performance, purpose. Why is corporate governance important? What are the basic principles of corporate governance? What are examples of corporate governance? It's the U.S. Germanic. There's a Japanese model, German model, U.S. model. Accountability, transparency, fairness, responsibility are the basic principles of corporate governance. And it's important because it creates a system of rules and practices that determines how a company operates and how it aligns the interests of all of its stakeholders. Good corporate governance leads to an ethical business practice, which leads to financial viability. And in closing, corporate governance consists of the guiding principles that a company puts in place to direct all of its operations, from compensation to risk management, employee treatment, to reporting unfair practices to its impact on the climate and more. A strong, transparent corporate governance leads to companies to make ethical decisions that benefit all of its stakeholders, allowing companies to place itself as an attractive option to investors if its financials are also healthy. Bad corporate governance leads to a breakdown of a company, offering resulting in scandals and bankruptcy. Okay, so yeah, so we did those 9 pages of notes. We did internal controls, going concern, corporate governance, and I don't know. I was thinking, because this was already kind of long doing this. So let's just see. Let's see. So if we did a third video, and that's my intention was to do a third one of these, we would have to pick up at 7. Yeah. Yeah, let's pick up there. Let's split these up so it's not just some big long monolithic video. So we'll pick up with question 7 with these sets of questions. What is orders of opinion a company? What is it based on? So as we're looking at this, there's some key words. Orders of opinion of companies. Orders of opinion is based on. What does an auditor test? What does it evaluate? Or what does it ensure? All right, so we want to go over all those words next time. We want to actually go through the Home Depot. We'll read that document and answer a lot of these questions in here, so we can review that. Okay, and it'll be sort of a reread of the sort of the initial video. So yeah, so now you guys have the lectures on all of these. You have the 1, 2, 3, 4, 5, 6, these 8. All right, these 8 topics. There's 8 of these. Okay, and you have the readings for these. I'm just going to put an 8 there. 8. Okay, and we'll pick that up next. We'll pick that up next time. Folks, thank you.